Hello everyone, in this video we're going to be going through some depreciation methods. Now these are going to be depreciation methods that are unique to FAR 1, okay, that basically meaning that they were not covered in ACG 2021, Introduction to Financial Accounting. Okay, so these are just a few depreciation methods that are covered in FAR 1 that are not covered in 2021. Okay, so the first one is sum of the year's digits. It's a depreciation method that results in decrease in charges for depreciation as the asset used for a longer period of time. Meaning that the depreciation that we take, it decreases over time. Okay, so maybe year 1 we would take 5,000 of depreciation, year 2 we might take like 3,000, year 3 we would take even less than year 2, and so on. Okay, so it means that it's decreasing charges for depreciation as the asset is used for a longer period of time, meaning that each year that we are later in the useful life, we're taking less and less depreciation. It's called the decreasing charge method. Okay, that's what it's called. Okay. The basic formula for the sum of the year's digits is depreciation expense equals the depreciation base, depreciable base, which is defined here, times the remaining life in years of the asset times the sum of all years. Okay, so the depreciable base is the cost minus the salvage value of the asset, and we multiply that by this sort of fraction here, which we will look at in some problems. Okay, to solve for the denominator, sum of all years, you can use the following mathematical equation. N is the useful life of the asset in years. So we do n times n plus 1 divided by 2, and the numerator is always the remaining life of the asset in years. Okay, so it's the remaining life of the asset in years over the sum of all the years in the asset's useful life. Okay, so basically what that would be is like if you had like n is equal to 5, then to use our formula we would do 5 times 6 divided by 2, that would give us 15. Okay, that's the sum of 5 plus 4 plus 3, plus 2, plus 1. It's the sum of all years in the useful life, because that would be 5, 9, 12, 14, 15. Okay, this formula is just n, which is 5, n plus 1 is 6, divided by 2 is 15. Okay, it's just a way to get to the denominator a little quicker. The remaining useful years, if it was 5, if there were 5 years left, it was at the beginning of the useful life, we do 5 over 15. If it's the next year, it's 4 over 15, and so on. Okay. Then we have group and composite methods. And again, we'll go through problems for all of these, so if that doesn't make full sense, that's fine for now. We're going to be going through some problems. Group and composite methods. These methods are used when a company wants to depreciate a group of assets at the same rate. The group method is used for assets that are similar in nature and have about the same useful lives, whereas the composite method is used for assets that are dissimilar in nature and have different useful lives. The composite depreciation rate is the rate used to depreciate all assets in the same group. Okay? And this is determined by dividing the total depreciation per year for all the assets in the group by the total cost of all the assets. And then after determining this rate, the company multiplies the rate by the total cost of all the assets to determine the depreciation per year. The composite life is the length of time it will take to depreciate the assets in the group to their residual values. And then finally, when a company retires an asset from the group, it does not record a gain or a loss, okay? When we generally get rid of an asset, okay, we sell an asset, or do we dispose of it, we retire it some way, we generally record gain or loss. Here, for composite and group methods, we do not record gain or loss. We either debit or credit accumulated depreciation for the difference between the amount received and the book value of the asset. And we will see an example of that because it is a little weird. Basically, GAAP just tells us to do this, so it's a requirement within GAAP, and so we are required to do this, okay? So that's basically a conceptual introduction. Let's go ahead and go through some problems. First, we have a sum of the year's digits problem. XYZ company purchased a piece of equipment on July 1st of 2017 for $10,000 cash. On July 1st of 2017, the company estimated that the equipment would have a useful life of 5 years. Salvage value would be $1,000. Additionally, the XYZ elected to use the sum of the year's digits method to depreciate the piece of equipment. Required, prepare the journal entries to record depreciation for the years ended December 31 of 2017 and December 31 of 2018. Okay, again, we need to remember how to do sum of year's digits. Well, we need to solve for our depreciable base, right? Again, depreciable base is cost minus salvage value. Okay, that's going to give us our depreciable base. Our cost is told to be $10,000. That's the amount that we pay for, right? So that's our cost. Minus our salvage value, it says is going to be $1,000, so that our depreciable base is $9,000. Okay, then we need to determine the denominator for the fraction. And again, the denominator for the fraction is the sum of all years. The way we solve for this is we do n times n plus 1 divided by 2. Okay, our n is our years. It's our useful life in years. So it's 5 times n plus 1, which would be 6, right? So it'd be 5 times 5 plus 1, which is 5 times 6. 30 over 2 is 15. Okay, Okay, 30 over 2 is 15. That's our denominator. Our numerator is going to be 5 years because there's 5 years remaining. Again, in our formula, it's the remaining life of the asset in years, okay, over the sum of all years times the depreciable base. Okay, so our depreciation for 2017, we take our depreciable base, we multiply by our fraction, the remaining years divided by the total of all years, and then we also have to remember to multiply by 6 over 12. And why is that? We have to be careful here because this asset was bought on July 1st of 2017. So we have to be careful with the dates, okay? So generally, we would actually take 3,000 of depreciation in the first year because we would take 9,000 times 5 over 15, and that would give us $3,000. However, in this case, we actually have to multiply by basically 1/2, right? 6 out of 12 months to get $1,500 of depreciation. So the depreciation entry for 2017 is depreciation expense, $1,500, accumulated depreciation as the credit for $1,500. Okay, so that's the first year for our problem. Okay, then for the second year, again, the depreciable base is still 9,000. That never changes. It's always going to be the same depreciable base. The denominator is always the same. The thing that changes is the numerator. Okay, so now we have 4.5 years remaining. Well, how do we get that? Okay, we start out with 5 years, right? And then we did 0.5 years because we did half of the year, right? So we did basically half of a year, which means we would have 4.5 years remaining as of January 1 of 2018, right? Because we bought the asset on July 1 of 2017, we would have used up half of the year for 2017, right? And that means we would have 4.5 years available as of January 1 of 2018, okay? Because we already used up half a year in the previous year, right? Because we bought it July 1st, we used up half a year, okay? So we do our formula, we do our depreciable base times the number of years left over the total number of years. So 4.5 over 15 equals $2,700. Depreciation expense, debit for $2,700, accumulated depreciation credit for $2,700. So that's basically how some of the year's digits works. The main things you have to remember how to do are solve for the depreciable base, get the denominator, get the numerator, and then you just make sure that if you have to adjust for any year, like in terms of if they bought it at a date other than January 1st, okay, then you have to adjust for the year as well. Okay, and you have to keep adjusting for the year as we go forward. Okay, so just to be careful of that as we move on, okay? Then we have our composite depreciation, composite method depreciation. XYZ company purchased 3 pieces of equipment on January 1st of 2017. The first piece of equipment cost $5,000, the second cost $10,000, and the third cost $8,000. January 1st of 2017, when they bought this equipment, the company estimated that all 3 pieces of equipment would have useful lives of 5 years, and the salvage values would be $1,000, $2,000, and $2,500 respectively for pieces 1, 2, and 3 respectively. Additionally, XYZ elected to use the group method to depreciate these pieces of equipment. Okay? So prepare the journal entries to record depreciation for XYZ for the year ended December 31 of 2017. Additionally, determine the composite depreciation rate and the composite life of the group of assets. Okay, so the way that we want to do this, again, is that we're using the group method. So we must have assets that are similar in nature and have about the same useful lives. Well, they have the exact same useful life, right? They're all 5 years for the useful life. It tells us that in the problem. And we have all pieces of equipment. So they are similar in nature, so that makes sense. Group method makes sense. What we want to do when we are solving these problems is we just want to set up a chart, okay? And the first thing we want to do is you just want to put out the original cost, okay? So it's 5 for equipment 1, 10 for equipment 2, 8 for equipment 3. Our salvage values were 1, 2, and 2,500 respectively, okay? That gives us our depreciable base, okay? We just take original cost minus salvage value, gives us our depreciable base. We subtract, right, across, gives us 4,000, 8,000, and then 5,500, okay? Then what we are going to do from there is that our depreciable base, we will go ahead and we divide that by the number of useful years, number of the useful life in years. So it's 5 years for each one, so we divide 4,000 by 5, get 800, 8,000 by 5, 1,800, 5,500 divided by 5, 1,100, okay? Then we get our total depreciation for the year for all 3 of these, okay? What we want to do from there is we want to determine the depreciation rate, okay? And the depreciation rate is defined as the depreciation per year divided by the total cost of the assets, okay? That is the definition of the composite depreciation rate. We can see it right here. It's determined divided by the total depreciation per year for all the assets by the total cost of the assets. So we take total depreciation per year, we divide it by the total cost of the assets, it gives us 15.22. That's actually one of the things we're supposed to solve for, composite depreciation rate. So we've done that. Okay. Then we also want to solve for the composite life of the group of assets. The composite life is taken as the depreciable base divided by the amount of depreciation per year. That gives you the composite life of the assets. It's 5 years, and that should make sense because all these assets have a 5-year useful life. So this should be 5 years, right? We're taking our depreciable base, which again, depreciable base is the total amount of depreciation we're going to take on these assets, assuming that we use them for the full 5 years, right? Because we're not going to go below the salvage value, right? We're not going to depreciate below the salvage value. So it makes sense that, okay, depreciable base divided by depreciation per year would give me 5 years, right? Because it would take me 5 years to depreciate 17,500 of depreciation at a rate of 3,500, right? Because again, to get these numbers, we've already subtracted out these salvage values to get to these depreciable base numbers. So that should all make sense mathematically, okay? The final thing to do is to determine the depreciation expense, okay? We kind of already did solve for it, but technically what you're supposed to do is you're supposed to take the original cost, multiply it by the depreciation rate, that gives us our depreciation per year. So that tells us depreciation expense, accumulated depreciation, debited and credited for $3,500. Okay, so that's basically what we need to know for these problems. They could ask us, what is the depreciation rate? What is the composite life? What's the depreciation expense? They could ask any of those things. We've gone through literally every single thing they could possibly ask us here. Okay, so if you need to re-look over something, that's perfectly fine. Rewatch it if you need to, but this is literally everything we could be asked, okay? The only last thing, at least on the depreciation side, the very last thing we could be asked about is a composite asset method retirement, okay? So now we're saying we have the same facts as above and assume that on January 1st, XYZ sells equipment 2 for $2,500. Well, let's flip back for a second. The cost of XYZ equipment 2 was $10,000, okay? So we're going to have to take that off the books at $10,000. Then we're going to debit cash because we're actually getting cash of $2,500, right? It says to record the journal entry for this, okay? So we're going to debit cash because we're receiving cash. We're going to take off the equipment. Well, the debit goes to accumulated depreciation. Why is that? Well, it says down here, this is kind of what I was talking about before. This is the weird thing with the composite method. GAAP tells us that when a company retires an asset from the group, it does not record a loss or a gain. It either debits or credits accumulated depreciation for the difference between the amount received and the book value. So we're not recording gain loss here. All we're doing is saying, how much are we receiving? What's the cost of the equipment? Okay, and then whatever the debit or credit needs to be to make up the difference, that goes to accumulated depreciation. Okay, so in this case, the equipment cost $10,000. We took that off. We got cash of $2,500. Well, we have a deficit on the debit side of $7,500. That means we debit accumulated depreciation for $7,500. There's no gain or loss recorded for the composite method. Okay, so that is the end of this video. Nothing too incredibly complex here. Just a little bit of stuff to practice and get familiar with because these are new methods. But again, these are not terribly challenging. We just have to make sure that we understand them for the exam. So that is the end of this topic, and I hope that was helpful.